Hi guys, thanks for tuning in to another episode of Nuggets News. We're back with our old friend JP. Some of you will know him well, some of you, this will be the first time you've seen him, but today we're going to be talking about THORChain. So the token is RUNE, you've probably heard of it, it's been making waves in the DeFi space. They've recently launched their ChaosNet, which is really important, and it's a world first. So we're going to dive into all that sort of stuff. So welcome back, JP.
Thanks, Alex, for having me back on.
So for those that haven't followed THORChain at all, I guess in a nutshell, what is it? Why is it important, and how is it different from other, I guess, dexes out there?
Sure. You can call THORChain a cross-chain Uniswap. You should be familiar with Uniswap, the ability to add two tokens together and provide liquidity to a market, and then anyone else should be able to swap across that pool from one token to another. And the Uniswap actually does a trade routing, so you can swap from one token to another, as long as there's two pools with interconnected assets. Uniswap is far better than the dexes before it, like IDEX and Ether Delta,
Yeah.
because it shifted away from P2P limit orders to what we call peer-to-pool, P2 pool. So you're not interacting with someone else. You don't need them to be there. You can execute a trade against a pool of static assets. And if you're profit seeking, anyone who can participate will ensure that those pool of assets are the correct market price at any given time. So although the pool is a static system and requires you to interact with it, it's always going to be the correct market price. And that's how Uniswap works.
Yeah, okay.
But Uniswap is only for Ethereum and ERC20s.
I'm just going to make some notes because you've already brought up some very interesting points I want to talk about later.
Sure thing.
But for those that maybe weren't around back in the old days, so Ether Delta, IDEX, these platforms you had to go to, and it was so confusing for beginners. You had to deposit from your ETH wallet into their ETH wallet smart contract, and then you had to kind of put in an order that you wanted to buy, and every click was an on-chain transaction. And so at the moment, it's congested. Back then, it was still hard. If it was congested and it was taking 30 seconds after you'd clicked, people were clicking 10 times, and then they didn't realize they'd created 10 transactions. And so it was slow, it was expensive, it was clunky, and you didn't have any chance of doing a trade if you didn't know what you were doing. So huge step forward in terms of being able to just go to a pool of assets and saying, well, that's the ratio between Ethereum or DAI or Tether and this asset, and you just pick out of that pool basically. So
Correct. Yeah. You put money in, and then the pool will execute and give you the other asset. So money in, money out. Yeah. So THORChain just takes this to the next level, and it tries to do this across chains. So think you've got Bitcoin and Ethereum, the chains, and Binance Smart Chain or Litecoin. Imagine if you can put the assets in those chains into pools, but across networks. So theoretically, you should be able to deposit Bitcoin into a vault on the Bitcoin chain, then have a decentralized system execute across those two chains, and then send ETH out. So the state machine is only aware of the balances in the Bitcoin on the Bitcoin side and the balances on the ETH side. So now it can give you a pool of assets to execute against. So that's what THORChain does. So it incentivizes people to put their assets in these vaults, these cross-chain vaults. I'm going to explain how that works. And it then kind of abstracts that to bring those two balances together. So you can put Bitcoin in and get ETH out.
Now, this is going to become, I guess, more important in future, because at the moment, when you just reel off those other chains, Litecoin is the only native asset on the Litecoin blockchain. But in future, Cardano are talking about having thousands of tokens. So that's when it's going to become very, very important for all these different cross chains. Now, in the past, there was talk about like atomic swaps and using time-locked contracts. So you kind of lock up your Litecoin, you lock up your Bitcoin, both share their private keys at the same time is the way to probably think about it. And then you do the trades on two separate blockchains. So what sort of tech, is there an easy way that we can explain to the audience how it works in your system?
Yeah, sure. Atomic swaps is peer-to-peer. So you and I, Alex, can get together and we can agree on a price, and I can say, hey, I'm going to give you 100 Litecoin, and you can give me one Bitcoin. So I deposit into a hash time lock contract. You deposit yours in a hash time lock contract. And then we can then exchange these proof of transactions, and then I will unlock one, which will reveal a secret, which you then get exposure to, and then you can use that to unlock on your side.
Yeah.
Immediate problem is three medium problems. One, peer-to-peer. It requires you and I to come together. Yeah. Two, it requires us to agree on a price. So price execution is a point of issue there. The third one is the user experience. So lots of different actions: deposit, reveal, swap, yada, yada, yada. THORChain is far simpler. So all you have to do is make a single Litecoin transaction in, and then wait 1 or 2.5 minutes for that to execute on the Litecoin chain, which you would have to do anyway for atomic swaps. But immediately you would get your ETH or your Bitcoin on the other side. And remember, once the UTXO is signed and spent and is in the mempool, that is spendable by you. It's owned by you. The system's not going to spend you. So a lot of people think, well, I've got to wait 2.5 minutes to confirm in and then another 10 minutes out. Incorrect. You'll wait 2.5 minutes to deposit Litecoin, and 5 seconds later, you'll have Bitcoin UTXO in the mempool, addressed to you, spendable by you, revealed in your wallet. So it's very fast. So imagine if you can go from Ethereum to Bitcoin. You can buy Bitcoin within 13 seconds to confirm the Ethereum chain. Literally 5 seconds later, you will have a Bitcoin UTXO in the mempool, addressed to you, spendable by you.
And some people have probably only experienced the slow side of things. So a lot of exchanges will require like 3 confirmations for Bitcoin, 2 or 3. And so you send your Bitcoin, you're waiting 20 minutes. Or for Ethereum, some exchanges require 30 confirmations. And so that's really confusing for a beginner. But for those of you that have used your MetaMask or any of these actual custodial wallets where you're in charge, as soon as you send Ethereum, it shows up. It's there straight away. It's not waiting at the protocol level. It's not waiting for 30 confirmations or anything like that. They're just things that exchanges have put in place. So
correct.
That's what you're kind of referencing there, right, JP?
Yeah, so you have to wait for it to be confirmed on chain and be valid in that chain before you can represent that safely and act on it as an information. Yeah. If you interact with the Uniswap contract, your entire trade is done as a single transaction. So if it was reorged out, then your entire trade is unwound backwards. So that's why Ethereum, swapping on Ethereum doesn't need, or through Uniswap, doesn't need any confirmations because of that safety. But when you do a cross-chain, you do have to wait for confirmations.
Yeah.
Now, here's the important distinction. The 6 conf Bitcoin limit and 20 confs ETH and 100 confs Bitcoin Cash is just a safety threshold.
Yeah.
THORChain has taken a very pragmatic approach to it. So the rough opportunity cost to mine a block on Bitcoin is equal to the reward gained from it, which is 6.25 Bitcoin per block. So that's roughly, you're looking at $360,000 per block. So it is safe to accept up to 6.25 Bitcoin with a single conf, and so on and so forth. So you can accept up to 12 Bitcoin with 2 confs and whatnot. Exchanges just give you a blanket 6 confs because 1, they're not pragmatic about it, and 2, they're just trying to be uber cautious. But THORChain takes a more pragmatic approach.
I like that. Okay, interesting. Now, the other thing that I wanted to talk about, lately there's been a lot of discussion around these bots that are front running, and people have probably heard about or seen the movies about Wall Street and these the bots that are doing these thousands of transactions per second, and they're front running. And I even made a whiteboard video explainer about this. So they see an order come in, and if they can get in 1,000th of a second beforehand, they can buy those shares at a price and then sell it to this next order that they know is coming in at a higher price. So this has started to happen on Ethereum as well, and it's miner-extractable value is this term. So miners get to choose like what transactions are included in a block, but also things like the order almost you can think of this as. So it's just been a huge point of exploitation with the bots. So do you have any just general thoughts on all of that, JP?
Yeah, sure. So front running used to be a speed-based thing. The faster you get your trade in to execute on NASDAQ or whatever, the quicker you're going to get in front of someone else's order. So you can buy up an asset before you see that buy order and then immediately sell it afterwards. So it's called a sandwich attack. You basically push up the price momentarily and then immediately drop it back down, and you extract value out of the trade you are sandwiching. So this on Ethereum is slightly different. There's no time-based requirement. There's a gas-based requirement. So miners, a front runner on Ethereum is just going to try and pay a higher G-way than you. So you do 100, it will do 300. And miners will dumbly put their transaction ahead. So I can front run you by just buying a much higher gas price. But what you just mentioned there, the miner-extractable value, taking the next level, you can have an out-of-band bit of communication with a miner and say, hey, can you always confirm my transactions? I'm going to pay 1 G-way gas price or lower, but I'm going to exploit these transactions and I'm going to pay you USDT or whatever later. And there's actually flashbots, there's infrastructure being built right now to automate that process. So you can submit a package to a mining network and with an inbuilt payment. So the miner goes, aha, you're submitting a sandwich attacker package to us. I can see your initial trade, I can see the victim trade, and then finally the out trade. And in this out trade is my commission and yours. So it automates it. Now, there's a whole bit of discourse because now you can sandwich attacks, and so on and so forth. And people can create, poison coins to trick miners and whatnot. So it's becoming extremely sophisticated. Now, the issue with this primarily is Uniswap, and this was highlighted in the Uniswap GitHub even as much as 18 months ago. And it's something that led to THORChain developing a different liquidity model back in 2018 when the project started. This wasn't an issue. Uniswap hadn't launched back then, but the team had an intuition that a fixed rate fee was not the correct economic design. With a fixed rate fee, I can sandwich attack you, Alex, for 60 basis points and pay no extra amounts in fees. So the team realized that was suboptimal. So they came up with an idea of a dynamic fee. So the more aggressive you are against the pool to change its price, the higher fee you will pay. Rough rule of thumb is if you change the price of the pool by 1%, you will pay a 1% pool fee. So it's 100 basis points, and so on and so forth. So it's proportional. So now, Alex, if you put an order in, THORChain will actually prioritize you and will give execution not to external gas prices, but to the fee you're willing to pay the network and the liquidity pool. So if two competing orders come in, one is trying to push the pool by 100 basis points, and one is trying to push the pool by 120 basis points, THORChain will deliberately prioritize the 121 because this person is willing to pay more in fees to the liquidity pool and not to Ethereum. So even if this one came in after this one in a time-based period of the 5-second block, it will still get executed before. And guess what? This completely kills the idea of front running, because a front running transaction will pay a higher fee. You'll pay 100 basis points, so they'll have to pay 120 basis points, so more fees than you to get prioritized in front of you, and then immediately pay 120 on the way down. So they will pay more fees than you do. So in that price change, they make no money.
Okay.
So it kills front running, and there's another reason why THORChain is invulnerable to basically transaction reordering by validators, and that's part of the way of witnesses and transactions. The Thor node has no ability to reorder transactions on the THORChain network because of the way it batches in transactions. But yes, front running is not an issue for THORChain.
ETH miners do have that ability though, like we just touched on. Is that
ETH
right?
ETH miners can reorder transactions, but no matter how those transactions are reordered, THORChain doesn't care.
Okay.
It will look at the value of those transactions against the pools that they're executing against.
And is with Ethereum, is that changing with proof of stake? Any of that?
So it's a good question.
I haven't looked into that. If you don't know, that's fine.
That's a bit of a rabbit hole.
That is an interesting thing to talk about, because you are proof of stake, aren't you? How does the node system work? Is it delegated proof of stake? Are these Thor, these master nodes? What's the sort of system for people at home?
Correct. So the THORChain runs on the idea that there is a group of nodes who are working collectively together to create these threshold signature vaults, which manage the external assets. A threshold signature vault is different to a multi-sig vault. Multi-sig has a predefined membership and a predefined threshold of that membership. A threshold signature just says, no, I just need 2/3 to sign, or 1/3. So it's a threshold, which means nobody knows, or there's no definition of who's required to be in that membership committee. It's just 2/3, right? And it's also ECDSA compatible. So it's compatible across Bitcoin, Ethereum, and more. So it means that these vaults just look like Bitcoin addresses or Ethereum addresses, and we have no idea whose membership is, who signed those transactions. Just that, 2/3 of the nodes got together and signed an outgoing transaction. Now, the problem here is that these nodes are now securing these threshold signature vaults. They don't have, they have secret shares which contribute to these vaults. They don't need to be part of any signing committees. They can just stay out, but they need to manage these vaults and churn these vaults forward. And additionally, if any of these nodes lose their key shares, the whole system can get locked up. So THORChain has a very aggressive churn schedule. Every 3 days, it pulls in 2 nodes and kicks out 2 nodes. Or if it's trying to expand its node set, it will pull in 2 and kick out 1. And it'll try and kick out the oldest node and the baddest node, defined by number of slash points, misbehavior points. So the system's always churning. It's always moving funds forward. So it's resistant to capture, resistant to centralization, and you can't stagnate. Now, a very important thing is this network is neutral, agnostic, and what we call amoral. It's not immoral, it's not moral, it's just amoral. It doesn't care of the morality of the transactions. That's not its role. So to prevent a slippery slope of centralization and also having basically subjectivity exerted on the network. THORChain does not allow any delegation. It does not allow any nodes to dox themselves or present a moniker, a brand, and whatnot. So if you go to delegated proof of stake blockchains like EOS and some other chains that have like logos everywhere, these nodes, they are paying marketing campaigns to get people to delegate to them. They can capture the chain. There's no churn schedule. You can stay in that chain for years.
And that's happened. That's been a huge issue. It's one of the main reasons EOS has been a failure, is that they promised that it was going to be like community driven and you could delegate for who you wanted, and little like genuine EOS community members like EOS Fear in Australia, they want to be one of those 21 block producers, but all the exchanges, you know, they have the money, the marketing campaigns, and it's just a popularity contest. So, yeah.
Correct. Yeah. So THORChain does not allow any delegation. It does not allow pooling of capital. The node operator is solely responsible for their bond. And there's no doxing. All you can identify a node operator is their IP address and the public key. And every 3 days, the whole system churns.
And how many nodes are there? And do they have to put anything? What is what do they have to put at stake?
Right. So there's a fixed number of node slots, and every 3 days, the nodes on standby, the highest bonded node will get put in. So there is a minimum for single chain ChaosNet, which has been running for the last 9 months on Binance Chain. It's got about 600 million locked up. It does about $30 to $40 million in volume today, and just Binance Chain assets. That has 36 nodes. 24 of them are active at any one time. So okay. 36 with 24 signing, and it's got another 20 on standby, just constantly churning. The minimum value required is about $12 to $15 million to get into that network. And that's purely set by the market. Multi-chain ChaosNet, we just launched 2 weeks ago by the team. That's currently got 7 active nodes and about 5 on standby. And it's slowly growing at set. You need it around 300,000 runes, so that's about $3 million to enter that. The multi-chain ChaosNet is still in beta, and it's still being proven out. There are some bugs that need to be addressed by the team. But the multi-chain ChaosNet is built to have 100 nodes with, and we talk about how it scales up to 100 nodes. But yeah, it's going to be far more decentralized, and it's a lot more capable than single chain ChaosNet, but it takes a while to spool up.
Okay. So just on that, like, you know, let's say you've got 24 and EOS have got 21. I'd say that you've already put forward the argument for why it's more decentralized, because they're just, you know, you don't know anything about them other than the IP address, and it's been turned over. So you would admit that it's not a fully decentralized like a Bitcoin or an Ethereum, but it's making the trade-offs that are best for what you want to do and the point you want to get to for the system.
Bitcoin's use case is a censorship-resistant, strictly scarce store of asset, which has irrefutable monetary integrity over 100 plus years. So that thing has to be incredibly decentralized, to the point where you need to run it on a Raspberry Pi. You need to put it in space. You need to transmit it over ham radio. Because for it to survive 100 years and never have any inflation issues or centralization, it needs to be a very lightweight, decentralized blockchain. Because it's going for the gold. Yeah. Ethereum doesn't have monetary aspirations, but it certainly has censorship-resistant compute aspirations to handle money, like wrap Bitcoin or USDT or whatever. So it needs to be pretty decentralized, but not too crazy decentralized. We haven't yet really seen any big attacks. We will see attacks on Bitcoin. We have seen attacks on Bitcoin because it's going for the gold. THORChain doesn't have those same requirements. THORChain only seeks to secure. It's not trying to secure Bitcoin, Ethereum, or whatever. It's just only trying to secure the assets in its own system. So you only need to compare it against those assets and the value of those assets in those transactions, nothing else. Single chain ChaosNet has 36 nodes at any one time, and which is almost double that of EOS. And that secures around 600 million. And 36 nodes bonding $15 million each. It's churned every 3 days. You would argue, I mean, Binance, KuCoin, Decentralisation, they theoretically have a single node, just one node. Does it make sense? Maybe like a 3 out of 4 multi-sig. So you're comparing 36 decentralized nodes with a 3 out of 4 multi-sig. So on that scale, THORChain is 10 times more decentralized and audible and censorship resistant than a KuCoin 3 out of 4 multi-sig, which has been attacked, by the way. So that's now multi-chain ChaosNet takes us up a step further. So it can be 3 times as big and go to 100 different nodes. It has the ability to shard its vaults. And it can even go higher, 200 prets, 200, 250 nodes. So when THORChain multi-chain has $10 billion locked up. You're going to say, well, it's got 100 nodes. They're each bonding, I don't know, $50 million each, and it's got 10 billion TVL. So you go, actually, you know what? I think that's pretty secure. I think that's pretty decentralized. So I know if I put in $1,000, this network is going to secure my $1,000.
Yeah, it's the game theory trade-off, really, isn't it? We were talking about this the other day. If THORChain, for example, was securing a lot of Bitcoin, you can say, well, how much does it cost to buy all the THORChain and take over all the nodes to try and capture the Bitcoin? So there's, I just love thinking about the game theory of a lot of these problems that we're going to face as well in the crypto community.
Yeah, so THORChain has what we call an incentive pendulum. So as the money is coming in the TVL, it is able to shift its block rewards between nodes and liquidity providers. So it always tries to ensure that the bonded capital is enough to protect the pooled capital. And if there's any imbalance, it will redirect the rewards to the wrong side. So if there's way too much security and not enough liquidity, then all the liquidity providers get paid. Or if it's vice versa, if there's too much liquidity and not enough security, liquidity providers don't get paid and the nodes get paid. So what happens then is the liquidity providers either leave or the nodes get bigger. So there's like an pendulum that's constantly going on to keep it in equilibrium. So THORChain, the system can safely expand and contract, which is unlike anything else I've seen before.
Okay, cool. Are there any other plans, like we sort of touched on it as well, how you don't have to wait, the different block times don't matter. ETH has a 15-second block time, Bitcoin has 10-minute. You explained why that doesn't really matter, but are there any plans or like big benefits for scaling in future? I mean, I guess at the moment with fees being so expensive, even that one confirmation and the one fee you pay on Ethereum or Bitcoin would be a huge difference if they scale. But are you having any plans to actually scale the THORChain blockchain?
Yeah, absolutely. So most of the volume on Uniswap is actually arbitrage volume. It's the occasional 1 out of 10 trades is just an opportune swap. Someone just wants to swap.
Yeah.
But they then cause a price change. And then immediately after that, there's like 9 different trades correcting that price. And even with ETH going up and down and various assets going down, there's continuous arb, because the second that the pool ratio is different to the market ratio in terms of price, there's an opportunity for someone to correct it. So 90%, more than 90% of the trades on these liquidity pool networks are arbitrage. So THORChain has an ability for anyone to mint a synthetic asset that has the same purchasing power as its liquidity pool asset, but it's settled on the THORChain ledger. So it still executes on these layer 1 pools and changes the price, but it uses a synthetic asset. So you'd be swapping from synthetic ETH to synthetic Bitcoin, but across the real ETH and the real Bitcoin pools, there'll be a price change. And we can talk about the economics here, how that works. What it means is 90% of all the volume, which is just arbitrage volume, chasing price all day, those traders will instantly switch to synths, because instead of paying $20 Bitcoin fees, you're paying 2-cent THORChain transaction fees, and you're settled within 5 seconds. So all the arbitrage will immediately switch to synths because it's faster, cheaper.
And they can still redeem the synth asset for the real asset.
At any stage, you can almost get one-to-one, because it's basically a pool swap, but you can get pretty close to one-to-one redemption on your L1 asset. So synthetic Bitcoin into real Bitcoin within literally 5 seconds. Boom, you've got a UTXO. So it's so all those arbitrages, the 9% of the trade is going to go to synthetic volume.
Yeah.
And it means you can rock up, and the lone trader, the one out of 10 trades, which is a genuine swap, will be done layer 1 and layer 1. Yeah, and okay. So there's heaps of bandwidth now to take them on.
Okay, cool. I like that. Anything else we haven't touched on so far, JP, that you think are features that are like the community is underrating at the moment and things like that?
Yeah, so I helped the team out with some of the economic and the architecture design. So it's a very, very exciting roadmap ahead, let me tell you. So the synthetic assets will allow basically the real L1 assets to be collateralized 50% by the real Bitcoin and 50% by RUNE. What it's done, the synthetic asset is actually minted by the liquidity pool share. So yeah, so $100 worth of USDT RUNE liquidity ownership will mint $100 worth of the actual synthetic asset, which has a claim on that liquidity, which is worth $100. And no matter which way the price changes, that claim is preserved. We could talk about impermanent loss and how
So
THORChain
how
addresses
is
that.
it not over collateralized? Like, why do synthetics have to have 500% over collateralization to create synthetic assets, but you're saying it's 1-to-1, or are you saying it's 2-to-1 because you need each?
No, it's one to one.
Okay.
So something like synthetics, the SNX project, they require anything from 300 to 700% over collateralization to mint like synthetic ETH.
Yeah.
That's primarily functionality of liquidity of the underlying collateral token SNX and price reflexivity. So causing deleveraging spirals. So if SNX starts collapsing and people rush to liquidate, it causes this SNX token to keep deleveraging, and it causes a spiral where things get out of control pretty quickly. Whereas THORChain mints its synths off liquidity pool shares. It's instantly liquidated. It's instantly liquid. So it's minted 1-to-1. The zero over collateralization is needed, right? And you're simply depositing liquidity shares to mint a synthetic asset. Now, that's just scratching the surface of what these things can do. With the synthetic Bitcoin, which is 50% collateralized by real Bitcoin and 50% collateralized by this RUNE asset, which is a liquidity asset, you will be able in the future to lock that up as collateral for a loan. So you'll be able to deposit your Bitcoin worth, say, 100 grand and pull out 50, 60, 70 grand worth of USDT. And this is like straight up USDT to your wallet, loan from the protocol. You'll pay a fixed interest rate back into the pool that you borrowed from, say the USDT pool, and that's taken from your collateral, the synthetic Bitcoin. So the synthetic Bitcoin is under the hood slowly swapped to the USDT pool. So lending is going to be a huge feature. You better rock up with your Bitcoin and borrow cash off it, which is tax-free because it's you're not disposing of an asset. Bitcoin retains its asset, right? So you better borrow a layer one, anything you want out of it. So that's the lending aspect. And
just
the unique
quickly,
thing about
what happens if if RUNE, for example, or can I come with any asset and mint any synthetic asset? Is that just what you said?
any to any.
Okay,
Yeah,
so what happens
has
if
to be
I come
supported by
with
THORChain.
ETH, it drops 50%, and all of a sudden I've gone from 1-to-1 collateralization ratio to 50% collateralization? What happens then?
Yeah, so THORChain has two member servicing schedules. It will look at your CDP and it will do a partial liquidation if your liquidation value drops down.
Okay.
But the other cool feature about THORChain, because THORChain is a state machine, it's a live state machine. It doesn't need you to poke it. It can wake up every 5 seconds and do something to itself.
Yeah.
So it wakes up every 5 seconds, inspects all its CDPs, all its members, and it can partially liquidate anyone that's unhealthy. But it can also do something that's really cool. That's a self-paying loan. So you can lock up liquidity assets which generate a yield because they are earning a yield out of the pool. And that yield is then liquidated to auto pay down your debt for you, on behalf of you, every 5 seconds, which is just unheard of in this space. So THORChain Finance, so THORFi lending allow you to lock up collateral and borrow assets out of the protocol. Fixed interest, no dynamic interest, so you have a fixed interest rate for the term of the loan. Auto servicing and auto liquidations all handled for you. Using synthetics and liquidity pool shares. Additionally, it's possible to actually lock those synths up and earn a yield on them. And basically, because those synths are derived from a liquidity pool share, which is earning yield, you can actually take that yield and pay it back to yourself in the asset, synthetic asset. So you can like lock up 1 Bitcoin of synth and slowly earn like a 10, 20% interest rate on just Bitcoin alone. Nothing to do with providing liquidity. It's all abstracted away. So this system is going to become a bank in its own rights. And it's not just limited to one asset. Any asset supported by THORChain will have this quality. You better lock it up and earn a yield by literally doing nothing but locking it up in a savings vault. It's insane. So that's the synthetic yield earnings feature, the lending feature we discussed. THORChain is also really uniquely qualified to serve two more things, which is like ETF style assets. So every asset in the THORChain network can be automatically managed. So if you wanted to buy Thor.DeFi or Thor.alt or Thor.USDT, you're basically buying an ETF coin that's linked to the value of the underlying, like 5, 6. You'll be able to create your own
Assets,
composites
indexes,
with the
or
RUNE.
baskets, yeah.
Yeah. And THORChain will automatically rebalance and there's a design that we have in mind that will be able to do it at really low slippage so that there's no rebalancing cost over time. Because what happens with these ETF coins and what have you, they every time they rebalance, they incur a loss. So there's a decay. So THORChain is uniquely positioned to almost have a zero decay ETF coin, which is just mind blowing.
Okay, I like it. Yeah, some people have found out the hard way about these indexes or like leverage products, the decay or the drag or whatever, because it's got to be handled some way on the back end to get that exposure. Whereas synthetic assets, it kind of changes that a little bit. I did like that the OGs in the space are getting excited. Like Eric Voorhees tweeted about ChaosNet during the week, because that's kind of what Shapeshift. Well, I guess the same idea, narrative, really. People wanted to be able to swap assets in a trustless fashion, and that's wasn't really easy to do. Uniswap have made it better. There's still questions around, can the US regulators shut that down if push comes to shove? But the way the guys at THORChain have done it from the beginning, it's kind of stealth mode. It's pretty, like we said before, even though it's not decentralized as such, the node structure, there's no CEO, there's no company. This is pretty unstoppable tech, isn't it?
Yeah, so let's have a look at all the weaknesses of the network and evaluate them. So if a Thor node in any jurisdiction is under pressure to not be a Thor node because they're deemed like a VAS or service provider of digital currencies, they can just leave the network immediately. And within 2 days, they are churned out, right? So the second they get that pressure, they can just leave and the network will just keep going on. And if they really want to be a Thor node because the rewards are so high, they can move jurisdiction to like Germany or somewhere else, Thailand, and have another go until they get pressure. So they can constantly do this. They don't need to dox themselves. They don't need to run marketing campaigns and whatnot. And I just want to highlight this, because Thor nodes have no ability to censor, stop, or have no input into the transactions that they push out from the network. All they do is just rock up to these signing ceremonies, exchange key shares, just sign messages with each other. No funds in them, just signing messages with each other. And the amalgamation, the aggregation of these signed messages equals a valid on-chain transaction. So Thor nodes don't handle funds. They just sign data with each other. It's insane. So the THORChain itself as a protocol is completely outside the purview of being a service provider of virtual assets, because Thor nodes don't handle funds. Does that make sense? So it's low risk in that sense. And by the way, there's nothing illegal about being a Thor node operator. It's just a little bit gray at the moment, uncertain, as it always is. But the second you feel like there's pressure, just leave. Liquidity providers as well, they just engage the network. They can withdraw the liquidity any moment they feel pleased. Now, in terms of the developers, a lot of the developers are actually community-based. So like some great community built tools like THORChain.net, the Viewbox Explorer, RUNE Yield, where you can see your yielding assets, the wallets, Shapeshift, and whatnot. These are all community-built tools. There's no centralization here.
Yeah.
There is a team of people shipping the protocol, but it's not deployed by them. It's not run by them. They don't run the nodes. So if THORChain is deemed like an issue by some agency in the world, who are you going to talk to? Are you going to talk to the Thor nodes and tell them to stop running the network? Well, I'll just leave. Are you going to talk to the developers? Well, they're not doing anything wrong. They're just shipping code. There's nothing wrong with shipping code. They're not deploying it to any network. So there's no point talking to developers. You can talk to community developers. Well, yeah, you can take down this website, but there's 6, 7 other ones. In fact, the team from last week, Trust Wallet, just announced they're going to integrate THORChain because they can send signed Bitcoin transactions directly into the network and execute these swaps. So now what are you going to do? You can tell Trust Wallet to shut down? No. I mean, there's nothing. Trust Wallet's not doing anything wrong. They're just signing messages on behalf of the user. So this network is very resistant to capture and centralization. And the team have been very deliberate about that.
No, it's probably the thing that I like about it most.
And additionally, I just want to highlight this point. A Mongolian crypto exchange or a Turkish crypto exchange is a black box. To get any information about who's trading on that exchange, it has to be subpoenaed. It has to be dragged in by the regulators and demand information. THORChain is completely open and public. If you want to know who swapped from this asset address to this chain and this, just query the API. It's all there. So in a sense, THORChain's publicly queryable state ledger is almost the regulators, holy grail.
It's like Bitcoin in some ways, yeah.
They can see the whole thing. In fact, they will want people to use THORChain because it has a publicly queryable transactional graph. I mean, THORChain is not designed. Are you going to
integrate with privacy coins? That's the next question then.
Right. So the way THORChain integrates privacy coins is so there's 2 types of privacy coins. There are opt-in privacy coins and opt-out privacy coins. Zcash is an example of an opt-in. You can transact on Zcash ledger. It's completely open public like Bitcoin. It's UTXO ledger. To opt in, you swap your Zcash to a shielded address and you enter the Zcash shielded pool. And what you do in there is completely private, but then you exit. So it's opt-in. Monero crypto note coins are opt-out privacy. Yeah. Every coin is ring signed and has plausible deniability on 11 other signatures. So there's no way, but you have no ability. It's by default every transaction, right? But you can opt out of that. So you can disclose your transaction view keys. You can also disclose these transaction keys that you get when you sign a transaction, which publicly makes your transaction public. So the way that THORChain interacts with these privacy coins is the full public mode. So when you transact into the network, you're completely doxxed. When all the vaults, completely doxxed. They disclose view keys and TX keys. When all the transactions out, completely doxxed. So THORChain makes Monero public, but so that's how it interacts with this Monero asset. It's in a completely public way. You better see all these vaults publicly and who's swapping the suit. If you swapped into Monero publicly and you moved it to another Monero address and you moved it again, that's entirely your permission. So when you interact with a Bitcoin mixer and I swap, I send a transaction, from your exchange and withdraw it, there's no issue there. The second that you put it into a Bitcoin mixer, then it's the Bitcoin mixer that is going to be the one under pressure.
Which we've seen.
And that we've seen. So, but there's nothing stopping with you making public transactions. It's just when you interact with these Bitcoin mixing servers. So the same with THORChain. When THORChain interacts with Monero, it's completely public. It's not doing any mixing or obfuscation or hiding. You have to go away yourself and in another wallet and in another environment, and you have to do the mixing transaction yourself. Nothing with THORChain. Okay. So there's no risk to THORChain. There's no increase in risk by interacting with privacy coins because it's full on public, full docs mode. Makes sense? You have to go away and do something to attain privacy. But that's not saying you can't. You know what I mean?
Yeah, I'm with you. Awesome. Well, that's been a fantastic overview. Have you got any other final thoughts, JP, or things you want to go over? But, that's fantastic. I think everyone at home's got a good understanding of THORChain now, hopefully.
Yeah, so THORChain is necessary infrastructure. Today, and THORChain is just in ChaosNet. It's got a funds cap. But the only way to swap between these 5 different chains today, Litecoin, Bitcoin Cash, Bitcoin, Binance, and Ethereum, is via THORChain. And it's growing. It's becoming more and more decentralized over the next few months. And the team will finally take off the ChaosNet flag and be called mainnet. But it's the first decentralized cross-chain liquidity protocol. Now, THORChain should not be the only. We need 3-4 cross-chain liquidity protocols. The team are massive supporters of Chainflip, also somewhat loosely connected to the Australian blockchain scene, because the wider world doesn't need just one option. It needs 5
Bancor started trying to tinker between Ethereum and EOS at one stage, I know. Red Fox Labs have built the bridges between a few different chains now. But I completely agree. It's like Kyber and Uniswap and 1inch, and now they can all, swap and draw, aggregate liquidity, relay. That's where you want to get to.
For sure. So we can't just have one protocol. We need 5-10 different options to really create a robust and resilient crypto industry that respects basic human rights of privacy and liberty to transact. That's what's needed here. THORChain is just one option, and it's a very viable option, and it's being built right now and iterated in public, and it's definitely 6 to 12 months ahead of anything else out there in the multi-chain world. But it's not the only one, and in future there's going to be many more. Now, the interesting as well, and this is a bit of insight I kind of am grappling with, is but decentralized finance will force TradFi or LegacyFi to respond and fix themselves up or be disrupted massively. Now, one interesting thing is synthetic assets like on the SNX, S Apple, S Tesla, and also mirrored assets on Terra, like mirror Apple, mirror Tesla. So you can buy synthetic Apple stock, synthetic Tesla stock, and we're going to see 4 or 5 different synthetic protocols launch over the next few years. This is actually going to force those real assets, the stock assets, to go digital, because if they don't, then more and more people are going to be buying synthetic Tesla or synthetic Apple, which does not drive any value into the underlying Apple stock. Does that make sense? Because it's a synthetic asset. It's not collateralized with Apple stock. So all that purchasing power to Apple is going to be diverted into a synthetic Apple, which does not drive any buying power into the real Apple stock.
And this is the black hole problem with gold and silver, because you can create synthetic products and there can be $1 trillion go and try and buy silver, doesn't drive up the price of real silver, and that's what you want to avoid for certain assets.
Yeah. So this is there's going to be a day of reckoning. Regulators are going to force themselves to digitalize their assets and make them more accessible to the world. A real on-chain Apple stock that's endorsed by, the US regulatory agency.
Of course.
Or they're gonna have to try and shut this thing down. And the really decentralized ones, and I believe Synthetic's design is really very well built, so it's quite decentralized. So in a way is Terra. But I believe that the first day of reckoning, well, there's 2 day of reckonings, is these synthetic protocols are going to have a day of reckoning, and they will survive if they're truly decentralized. The second day of reckoning is the upcoming regulatory purview, or the push to regulate things like Uniswap, and there's draft FAST guidelines and what are coming out of the FAT fee and whatnot. But Uniswap is funny because it's based out of New York City, and it's now got a $4-5 billion treasury. Uniswap don't want to be shut down, and they got a $4-5 billion treasury. So you can guarantee that those guys pulling in regulators right now into the offices in New York and going, let's make this work. So I'm really glad that the Uniswap project has had huge amounts of tailwind, really strong project or strong treasury. You can guarantee those guys are talking to regulators right now, trying to get this whole industry in the right direction.
The other thing that it enables, which is it's already created some of the best trading opportunities we've had in the past couple of years. Gold, oil, Apple stock, Tesla, they don't trade 24/7. And there's been a couple of times now where these things that trade 24/7, you can buy them on a weekend when you know that they're going to pump or dump at market open. And that is where price discovery is going to maybe come from the other way. Maybe it's the synthetic assets that are starting to determine the fair market price, even though they're not driving the value into the underlying asset. But I'm not sure if you've thought about like that before, but yeah.
Yeah, the whole limitations around trading hours and that whole industry is going to get a shake up.
Yeah.
And like Alex, you've got an asset. I don't know, you've probably got like a holiday home in somewhere in Tasmania that's in a faraway place. It's not really on the market, but you wish to loan against that asset. You walk into a bank, you're probably getting laughed out of the room because your asset is not liquid.
Yeah.
And no bank is going to willing to lend on you, right?
Yeah.
So the whole idea that the middle class people don't have access to these lending, the small businesses, they have these assets, but they can't get a user's collateral to draw loans out from. All of those games have been owned by the elite. You own $1 billion in stocks. You can rock up to a bank and get issued $100 million in a loan. Don't pay any tax. Yeah. And you can go away and live what you want, right? And these guys, these billionaires and these millionaires pay no tax because they can play these big games, these elite games.
Yeah.
DeFi is allowing anyone with just $100 in your account, like Alchemix.fi, to lock up your collateral and give you a loan against it. And that is what I'm here for, to be honest. That's why I participate in this industry to push that forward. The idea that these elite money games that have been played by people well up in the classes because they have been out of reach of the common folk. And it's now in reach. You can get a loan against your collateral. You can swap between different assets. You can yield farm. You can be access to these early stage investment opportunities across the DeFi space. Yeah. That is true. That is true fundamental change. And this DeFi system, this DeFi idea is out of the bag now.
Oh yeah,
it's never going to be put back in.
I think it's great. And a lot of the people that are in that industry are the people that have good ethics are leaving to join this industry. The only people that are going to be left there are the ones that just benefit so greatly because of how unfair it is. But mate, it's nearly bath time at our household, and we've already spoken for a lot longer than we thought we were probably going to speak for. So any final thoughts for people?
No, that's great, honestly. And Alex, as we were remarking before, as long as you stayed in the last 3 or 4 years, you're massively multiplied up. So all your listeners, we're coming up to a cycle end soon, 6 to 9 months. Be prepared. It's going to correct back down. Don't freak out. But if you really commit yourself to 3 to 4 years, maybe a bit longer in this industry, and you stay involved, there's so much to learn, so much to benefit, so much to help out, so much to change. Right. You really want to have an impact to the world. This is the industry to be in. Yeah.
Oh, 100%. I don't know anyone that's been in for a few years that hasn't changed their life and they're thinking about it, even if it necessarily hasn't been getting rich per se. But awesome chat, JP. I'll put all the links down below to follow you and the project and everything. And I know everyone that got a little THORChain airdrop a while back are all licking their lips now because it's gone up like 100x or something ridiculous. So well done on all that, and we'll talk again soon.
Thanks, Alex.
Cheers, guys. Bye.